This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, welcome back to the Realize Your Wealth podcast. Super excited to be here today. Super excited to dive into things with Greg, my co-host. I mean, what's happening in your world these days, Greg? What's going on?
Well, I think most clients know we're expecting our first baby. So my wife, we make the joke because in her first trimester, she didn't look pregnant at all. She was running half marathons. We made the joke she didn't even feel pregnant, but now she's starting to feel pregnant. She's starting to look pregnant. She's slowing down a little bit, but we made the joke the baby is closer to coming than when we found out. So it's coming fast. So we're getting everything ready to go. We got the nursery. We got the colors picked out. We're going with like a green type of vibe, jungly theme in the nursery. So we're just kind of dotting our I's, crossing our T's on that front.
Oh no, that's awesome. And you've got Keely now in the office to lean on for advice and me as well when it comes to the little ones to navigate through that, which is awesome. But no, we're super excited for you. It's exciting stuff. It's awesome.
Yeah, we made the joke that Aretec is kind of my first baby, right? A little bit of a warm up, and then in March the second baby's coming. So I'm having two kids in quick succession. So it's been fun.
Oh, that's awesome. Yeah, and there's another baby in the office on the way because Courtney's having her second, right? So we got lots of babies on the way. It's a family business, family values at Aretec, which is awesome, and it's very, very cool to see.
We're already building our pipeline for new employees coming down the hopper, so it's good. I think Courtney's having a boy. We're having a boy. She has a girl. Will obviously has a boy and 3 girls. So we've got a real mixed bag of skill sets that Aretec can look forward to.
Oh yeah. So excited to get into things today, and what we want to talk about. We want to talk about value when it comes to investing, and probably more specifically value when it comes to wealth management. It reminds me of a quote, a Warren Buffett quote, the Oracle of Omaha. Price is what you pay, value is what you get. Wise investor, very smart investor. We don't invest exactly like Warren, but I think a lot of his principles and philosophies are very, very sound overall, and that's what they are. They're principles. There's a lot of truth to them, and I think we can kind of unpack. And that's something I've thought a lot about when it comes to business and investing and wealth management. And I think oftentimes that idea, price is what you pay, value is what you get. When you think of that with Warren Buffett as a value investor, it's really about buying low and selling high, and that traditional idea of buying assets when they're very cheap and inexpensive, and selling them when they're much more fully valued. But we want to take a little bit of a different spin on that today, and we want to talk about what we do in wealth management, and really when it relates to your money, your wealth, and your investments, that price is what you pay, value is what you get, and we want to unpack that a little bit today.
Yeah, and it's a good distinction because a lot of people, I think, they just kind of mix price and value, and they just think it's kind of one and the same, but it's actually very different, and they're not intertwined at all, although a lot of people will try to put them together. They're very separate, they're very distinct, and they're definitely not the same.
Yeah, and the reason it comes up in wealth management, I think, because there are a lot of areas that have become very commoditized in wealth management. So when you look at things like index investing, the cost of an S&P 500 or a TSX index fund or any of those has ground down to near zero, right? I mean, you can buy the market for 5 or 10 basis points. So to be invested in purely an index solution, you probably shouldn't be paying more than 5 or 10 basis points, which is 0.5 or 0.1%. And there's a ton of areas in wealth management. I think investing is probably the most obvious one. But when it comes to the wealth planning, when it comes to the broader wealth management, and frankly even the relationship side, in a lot of cases that has been commoditized down, where you can get a lot of things that are basically that commodities. You can get them anywhere. You can get them for near zero in pricing and fees. And so there's a lot of areas that Price is what you pay, value is what you get. Certainly what we do at Aretec, what we do with our clients, our investors, our families, is certainly not a commoditized offering. It's something that we price fair market value for, and are very very proud of and very excited about our unique and differentiated value offering. But we wanted to talk about that a little bit today.
Yeah, and when you think of things out there where they're slashing, price, right? You think of maybe gas, maybe groceries. Well, we were talking about this, maybe laundry detergent, because they're commodities, right? There's nothing really, special or fancy about it, and that's where you can, cut prices. But when we're really trying to give value, you want to make sure you're getting value.
Yeah, there's things that you do want to cut costs on, right? And I would say, if you could save borrowing costs, right, and cut your interest rate down, by all means, right? If you could save at the grocery store, by all means, right? If you could save at the gas pump, by all means. And like, everybody's felt that the pinch of inflation and everything that's gone on, especially since COVID in the economy, and prices have gone up for sure. I would say, there's certain areas in life that you want to cut costs and pinch pennies, and absolutely that makes sense. And those, are things that aren't really that valuable or that important to you, right? But when it comes to your money, your wealth, I mean, frankly, your financial freedom, your independence, your retirement, that's probably not where you want to pinch pennies for a whole host of reasons, because, we're talking in a lot of cases about multi-million-dollar investment portfolios that are going to represent your financial freedom, your retirement, really the rest of your life, and trying to pay the lowest possible cost for that, something that I think can run investors into a lot of trouble.
Yeah, where you really cut costs is when there's no differentiation, right? And that's where the commodity analogy comes in. But Will, at Aretec, we've built a unique and differentiated value proposition. So do you maybe just want to get into a little bit about that?
Yeah, I mean, I think one of the ways to talk about it, though, is what it's not, right, when it comes to the portfolio management solution. So I think on the investment side, first and foremost, it's not a passive index fund solution. And I think when you look at a lot of the offerings out there, they really are that. They're index type investments. They're mirroring the index. They're buy and hold type solutions. It's basically fundamentally only stock picking, not a lot of trading or active management that happens in the portfolio. And it's just, you might see a portfolio of 10 or 15 stocks, and that's it, and they get moved around every once in a while, but there's nothing unique and different about that. So that's one way to kind of negatively define what we're not, because our approach is one that is active, it's tactical, we manage, we navigate the risks of the market, we move from offense to defense based on changing market conditions. We go from a green light to a yellow light to a red light type approach, and shift and change clients' portfolios based on what's happening out there in the world. So it's not something where we're shifting asset allocation just because maybe you got a little bit older, or you filled out a form that said, not that those things are not important considerations. I don't think they go far enough overall. So we change portfolio allocations based on changing market conditions, based on risks and opportunities that are out there in the market.
Yeah, and most strategies and most portfolios, I had a client actually mention this to me. They appreciate the fact how we're not always going to be fully invested or pedal to the metal. We have the ability to oscillate and change the portfolio based on what's happening out there, where even if you're not indexing, most portfolios are going to kind of, by and large, just stay the same in terms of the asset allocation, which is that's not what we're doing here.
No, and that's I think one of the problems when you talk about, okay, if we're going to pay nothing or next to nothing for a wealth management plan, I mean, or a portfolio management plan, what's the risk management plan for the next bear market, right? And it's not, I'm not saying that that's happening, now, or it's right around the corner, but we know that there's going to be another bad market, right? And most portfolios don't have an insurance plan. They don't have a strategy for dealing with the bad times, and that's what really makes a money manager, an asset manager, valuable. And my opinion is how well they do in the bad times, because anybody can make money in the good times. All you have to do is buy an index fund and you're going to go up, 10, 15% a year, no problem. But how do you navigate the downside? How do you navigate the bear markets? How do you navigate the uncertainty that's out there in the world?
Yeah, and every money manager looks really good in a bull market, right? You look at 2024, you had stocks up, right? You had technology up, you had traditional value businesses up. Everything was going up, so it's very, very easy to look really good. But where the money is made and where the rubber hits the road is what do you do in a bad market, and that's really where our process is grounded. I mean, that's why we got the polar bear still there, right? Because it's going to protect and it's going to defend, and that's really the essence of our strategy.
Yeah, look, and signals change and indicators change in the markets all the time, and we had that scenario in COVID, right, in the pandemic where, like if you asked me in January of 2020, I mean, the market looked fine, right? It was a green light scenario. We noticed risk out there in the markets. In February, we shifted to more of a cautious and yellow light stance. But by the time late February, early March of 2020 came around, we were in a full red light defensive position for clients and had clients, as defensive as we could get them for the market environment. And that COVID-19 crash that was, 20, 30+% decline, our clients, our investors were largely insulated against that. And, we turn around and, markets thankfully recovered pretty quickly there. But, we turn around and our strategy, we're able to get money reinvested quickly. And I think, how you navigate the downside, how you navigate the drawdowns, that's what really makes a money manager strong and successful and valuable out there. And, our strategy, tactical wealth portfolio is akin to a lot of, I would say, sort of the hedge fund or alternative asset type strategies that, would charge you very, very premium. It's the 2 and 20 model, a 2% fee plus 20% performance fee. Our pricing, our fee, and value model, is nowhere near that when it comes to the portfolio. But there's a lot of other elements that we add in, I would say, in terms of the wealth planning, the wealth management, the relationship side, the behavioral finance side as well.
Yeah, so the portfolio is kind of that first important pillar of our unique differentiated value proposition. But as you said, Will, it goes a lot deeper than that. So the second piece is just obviously on that planning element.
Yeah, and I think even when you look at a lot of plans out there, they are frankly commoditized, right? Where oftentimes they're used as what I would say are almost like sales tools. People will plug, advisors will plug numbers into a software program, make a bunch of projections, and a lot of times there's ulterior motives or hidden agendas to sell you other products and services. So it's really not plugging numbers into a software program. I mean, frankly, AI could do that, right? Or you could do that yourself and make a projection. There's not a lot of value in that, right? What to me the value in planning is when you have deep, creative, strategic thinking about your financial situation, an advisor sitting down with you and thinking through what your goals and objectives are, what you're looking to achieve, what worst case scenarios are, and really mapping it all out and laying it down on paper. Something that would be closer to a blueprint if you're building a house, or frankly, a strategic life plan or even a strategic business plan. The level of depth, detail, thinking, and creativity that will go into. So, planning is much more than plugging numbers into a software. And I think you also want your plan to be done by ideally someone who is independent, is not out there with another agenda to sell you a product or service. And that's where some of the independent CFP planning comes in.
Yeah, and that's honestly where our strategic asset maps also came in, because we wanted to move away from those big, bulky financial plans that are 50, 75-page documents that no one can really understand.
Right.
There's numbers, there's projections everywhere. It's really hard to decipher. Where our strategic asset map, it's a 10, maybe 15-page document. It's really a slide deck for a blueprint of your financial future, right? That basically lays out where you are now, where you want to be, and what you need to do to get there. So it's a simple, concise version of what's known as a traditional bulky financial plan.
Yeah, I think most people have seen those when you get a 100-page report or printout, right? That's just from plugging your financial numbers, and next thing you're being offered a bunch of products and services that you didn't want or need that are tied to that plan. That's not really the ideal experience. Like a real valuable planning should be completely about you,
Yeah.
completely about what's in it for you, your best interest, your family, your money. And frankly, I think one of the things that we're able to do at Aretec now is we can better integrate experts. We can go right to the source, whether it's an accountant, a lawyer when it comes to estate planning, an insurance expert, an independent fiduciary, CFP. We can just go right to the real world and right to the external experts who can get things done for you.
Yeah, and I think a lot of the value also comes from the critical thinking that it comes from the advisor and the client, because when you do a traditional financial plan, there's not a lot of critical thinking that goes into it. It's plugging numbers into a software and it's making a projection. But with our strategic asset map, with the independent certified financial planning, it's really looking at your situation and thinking hard about different variables and different factors that you probably won't get from a traditional plan.
Yeah, look, you need your advisor. In my opinion, what's valuable is if you have an advisor that can provide leadership, right? Can think strategically, think creatively about your situation, and you also have a relationship with that advisor. It's someone that you like, and trust.
Yep.
That's how you're going to plan out. When it comes to your investments, when it comes to your portfolio, when it comes to your financial and wealth and retirement plan. You need someone who's a leader, who's going to carry you through all conditions in the market and the economy, is going to map that all out for you and help actually make it come to life. Help hold you accountable. I think one of the other things when it comes to that relationship, knowing, liking, and trusting your advisor, not just not just some random person you've just met, because there's a behavioral investment element or behavioral finance element, which is a very good advisor. They act much more as a coach, an educator, a leader. What I mean by behavioral finance is helping you do things that are in your best interest that you may not have done otherwise. And that's what we really pride ourselves at Aretec, at our firm, is helping clients do what's in their best interest. That maybe it's something that you wouldn't have looked at, or maybe would have ignored, or wouldn't have taken into consideration. And that's been really the process of this whole business has been educating clients and coaching them and really leading them into what's in their best interest.
Yeah, and helping them look at things from a different perspective. We're at the end of the year, it's tax time. It's making sure we're dotting the I's, crossing the T's for the tax year 2024, make sure we're setting up properly for 2025. So it's basically having those conversations to make sure you're set up as efficiently and effectively as possible.
Yeah, look, that's a little bit when you dive into value on planning and the say the relationship side, that that's not something that you're going to pay nothing for, right? It's not something that you're going to pay 5 or 10 basis points for, because some of these things and some of these decisions, whether it's how you navigate the market, implementing a financial and wealth and retirement plan, some of the behavioral stuff as well, that could be worth tens of thousands of dollars or more in value every year. And I think that kind of goes back to the Vanguard
study.
Yeah, the Vanguard study, which is an interesting one.
Yeah, and it's basically, I think it's a good advisor, and it's interesting because Vanguard, they're the king of passive investing.
Yeah.
Right, but they have a study out there that says, working with a good advisor, I think is it 3 to 5%?
Well, I think the Vanguard study's 3%. That's assuming you're in a totally indexed solution. But if you have a very good advisor that's going to look at all the financial planning, all the wealth planning, tax planning, estate planning, everything that goes into your whole financial picture, making it as efficient, as effective, and then layering in that behavioral finance element, so helping you do things that are in your best interest that you otherwise might not have done. That's a 3% value. What I'll say, when you add in our portfolio management process, our investment management process, the tactical wealth portfolio, what we're looking to do is drive relative returns that are 2% over and above the benchmark, a blended benchmark for an asset mix. So, that means, are we doing that for clients, every single, day, every single week, month, year? No. But, if that's a good year, you could have, 5% of value over and above a totally indexed type solution, a do-it-yourself solution. And that's not even factored in the things that people do to sort of blow themselves up or shoot themselves in the foot when they're basically trying to operate on themselves when they're managing their own money.
Right, because it's easy to look kind of in hindsight and said, well, if I just left my money in here, it would have done X. But the reality is you're not going to just leave your money there when you're looking at a minus 20, minus 30 market downturn, right? So that's where the value not only of a good advisor will, but also a good investment management process to make sure you're actually navigating through that, because a lot of advisors, they'll act more as a therapist maybe in a bad market, but we want to help coach our clients in a bad market, but also have a way to actually navigate a bad market.
Oh yeah, and that's big, and I think especially when it comes to the retail wealth management industry, a lot of that is missing, where it's just don't worry, everything's going to be okay, right? Just ride it up, ride it down, right? And that's the standard messaging that everybody hears, and my view is, why not have an advisor that will navigate through the bad times and steer you through that, right? And yes, there's a behavioral element to it, but there's also an investment element in terms of how you navigate through those bear market, through those negative market conditions, and how you carry through all that. And that's really what our portfolio management process is all about. It's not about taking on more risk. It's not about trying to make 30% when the market's up 20, but it is about not losing you 30% when the market's down 30%, right? Or protecting and preserving capital in those bad times and those bear market conditions. And that's why we've got the polar bear here as well. He's standing watching over us, right? But it's really about how you do in those bad times, not in the good times, right? When everything is rosy and optimistic. It's for us, it's navigating through the uncertainty.
Yeah. So a lot of people they'll first question they'll ask is about fees. But really we have to shift the conversation to, okay, what's the value? So maybe just walk us through kind of our value structure.
Yeah. Look, we could certainly talk about fee structure, and as you just mentioned, right, is we'll call it a value structure. So what are you getting? What's the value you're getting for the fees that you're paying? And I would say on the investment management side, you're getting what I align with more of an institutional caliber, institutional grade investment management solution. It's got hedge fund alternative characteristics, but we're bringing it to regular investors. Right. This is not a hedge fund strategy that you have to have $100 million to be invested in, right? This is for regular people, normal investors that frankly are probably underserved by strategies like this, and institutional money managers are using them all over the world, right, and navigating in a better way through markets, and we're bringing that to a regular investor. Typically for that, you'd be paying 2%, the 2 and 20, 2% plus 20% of profits. In the hedge fund world. In our world, we're always coming in, well underneath that. When you start to look to the value, right, of that full financial wealth retirement plan, that multi-family office experience, right, where we can integrate things like tax, estate planning, independent CFP financial planning, do it all in one place. To me, that has probably easily $5,000 to $10,000 of value for the typical client, and you combine that with the behavioral elements that could be that 3% or so, right, that you see from Vanguard. So what we're talking about is this could be 5% of value easily for a portfolio on an annual basis, and our fee structure starts at 1.75, and tiers down to 0.75. So typically clients are coming well and under under that 2% mark that I talked about. I think probably an average client is in there at something like 1.25%, but that's potentially for 5% of value on an annual basis. So that's what our value proposition, that's our fee structure, but really our value structure, our unique differentiated value proposition. And I would argue that most advisors, most people in the industry are not presenting a solution like that for clients. Maybe why that they've ground their prices down to zero or close to zero.
Right.
But that's also why I say that we're a wealth management firm, Aretec Wealth, for Canadian families who don't want a good enough solution for their wealth management. They want a solution that's the best it can possibly be, and that's what we're all about. So we're here for you, for your family, for your money, your wealth, friends, family, colleagues. We're here for you as well, and we're here to help you realize your wealth. So thank you for joining us, everyone, and we'll be back with you next week.